You know, I was looking at the terminal this morning. It's Wednesday, January 28th, 2026. And it felt like I was watching two completely different movies playing on the same screen. It was just jarring.
It's a split-screen reality right now, isn't it?
It really is. On the left side of my monitor, you have gold just smashing through 52.80 an ounce. I mean, it's vertical.
This is a straight lineup.
Exactly. And that is the ultimate fear trade. It's the market screaming that it doesn't trust the currency, it doesn't trust the debt, and it just wants out of the system entirely.
It's pure risk-off behavior.
Yeah.
Classic flight to safety.
Right. But then, I look over at the right side of the screen, and there's Elon Musk, who is, and I'm not making this up, he is effectively waiting for the planets to align, literally, the actual planet.
Literal planets, yeah.
So he can list SpaceX at a valuation of $1.5 trillion. And that is the most risk-on, euphoric, aggressive signal you could possibly imagine.
It is a completely surreal juxtaposition.
Mm-hmm.
You have what you're calling the debasement trade, running at full speed right alongside, well, the greatest speculative tech bubble in history, if you can even call it a bubble.
I'm not sure you can anymore. It reminded me of that options trading concept, Theta, the time decay.
Right, the burning fuse.
Yeah, and for the benefit of anyone listening who doesn't spend their days just staring at Greeks on an options chain, Theta is basically the measurement of how much value an option loses as it gets closer to its expiration date.
It's the rate of decline.
Exactly. The closer you get to the event, the faster the value vanishes if you aren't in the money. And it feels like the global economy is in a high theta moment right now.
That is a perfect analogy. We're compressing. You have these massive events, the Fed leadership crisis, the semiconductor explosion, the debasement of the dollar, all of them converging at once. Time is running out to pick a side.
And usually in a normal market, you can hedge, right? You buy bonds to hedge your stocks. It's standard 60-40 portfolio stuff. But today,
bonds are selling off too. There's nowhere to hide in the traditional sense.
So the mission for this deep dive isn't just to look at the headlines. It's to figure out where to hide or maybe where to attack when that Theta Fuse finally runs out. And I think we have to start with the explosion in the chip sector, because those ASML numbers were, frankly, they look like a typo.
It really did look like a typo.
Yeah.
But they confirmed something we've been debating for, 18 months now?
Which is whether this AI boom is just a sugar high or if it's a real structural shift in the economy.
Exactly. And ASML just slammed the gavel down. Mm-hmm. To understand why, you have to look at the expectations. The analysts who cover this for a living, they were looking for bookings of around 6.85 billion euros.
Okay, so just under 7 billion, and that was considered the optimistic consensus rate.
That's a bull case.
Yeah.
And what did they actually print?
13.2 billion euros.
Oh, wow. So that's nearly double. That is a massive miss by the analysts. It's a demolition. That is roughly, 15.8 billion US dollars in orders in a single quarter. And you have to understand the context of these orders. You don't just go to, Amazon and click buy now on a lithography machine.
No, these are multi-year capital commitments from the biggest companies in the world.
And they're for the machines that TSMC, Samsung, and Intel use to print the actual chips.
The absolute bedrock of the entire industry.
Correct. They are the monopoly. If you want high-end chips, you have to go through ASML. So when their bookings double expectations, it tells you that the biggest companies on Earth, Meta, Microsoft, Google, you name it, are going back to the chip makers and saying, we need more capacity, and we need it yesterday.
This brings up a quote from their CEO, Christophe Fouquet. He's relatively new in the seat, isn't he?
He is. And he's been navigating a tricky period where customers were sort of digesting their previous purchases. There was a bit of a lull.
Right.
But he told Bloomberg yesterday, and this is the key line, the last 3 months have brought a lot of clarity.
Clarity. That is a very, very polite way of saying panic buying.
It absolutely is. He expanded on it, noting that customers have moved from what he called testing phases to aggressive capacity building. That is the key shift.
So it's gone from a science experiment to an arms race.
Precisely. 6 months ago, companies were buying a rack of chips to see if they could build a useful model. Now they're buying entire data centers worth of chips because they know the demand is sustainable and they are terrified of running out of compute power.
It's the infrastructure build-out phase. It's exactly like the railroads in the 19th century. You have to lay the track before the trains can run.
And everyone is laying track as fast as they can. But there's a technical detail in this report that I think is even more important than that headline number. It's the mention of the high-NA systems.
Okay, let's pause on high-NA for a second. We hear this acronym thrown around constantly in the semi-space. High numerical aperture. In plain English, why does a piece of glass, or I guess a set of mirrors in this case, why does it change the entire AI landscape?
It all comes down to how small of a line you can draw with light. I mean, at its core, that's what lithography is.
Just drawing circuits on silicon.
Right. And think of the current EUV machines, which are already, miracles of modern engineering. Think of them like a very high-end Sharpie marker. You can draw incredibly detailed pictures with it, but there is a physical limit to how thin that line can be.
And to make chips faster and more power efficient, we need to pack the transistors tighter together, so we need a thinner line.
Exactly. High-NA changes the physics. It changes the angle of the light, the aperture, which allows the lens to focus that light into a much, much sharper point. It effectively turns that Sharpie into a fine point needle.
Which means you can pack billions more transistors onto the same square millimeter of silicon.
And that is what allows the next generation of AI models to even exist. Without this, you hit a wall. But the crucial point here, the thing that made traders sit up, is that we aren't talking about lab tests anymore.
Right. This wasn't a footnote about R&D.
No. ASML confirmed they recognize revenue for the first high-NA system. The model is the 5200B, and it's been installed for high-volume manufacturing.
That's the signal. That's the whole ball game right there. It means TSMC or Intel or whoever bought it is actually turning this machine on to print chips that will go into commercial servers.
Yes. It means the 2-nanometer and 1.4-nanometer nodes are becoming a commercial reality. The roadmap is real. This is why the stock is hitting record highs, and it's why it drags NVIDIA and TSMC up with it. It validates the entire ecosystem's future.
But, and I have to play devil's advocate here. There is a part of this report that just doesn't smell right to me. If they're selling these, $350 million machines?
Around that, yeah.
And their bookings just doubled all expectations, why on earth are they firing 1,700 people?
Yeah, it does look contradictory on the surface, doesn't it?
Yeah.
It's the first thing that jumps out.
It looks like panic. Or at least, it looks like they don't trust their own growth numbers. If I'm a CEO and I'm booked solid for the next 5 years and I have a monopoly, I'm usually hiring engineers, not firing them.
I see it a little differently. I think this is the difference between growth at all costs, which was the mantra of the last decade, ZIRP and all that.
Right, when money was free.
And profitable scaling, which is the mantra of 2026. This is a sign of maturity.
You think it's just belt tightening, just good corporate hygiene?
I think it's discipline. Christophe Fouquet is under pressure not just to sell the machines, but to optimize the machine that is the company. Those 1,700 jobs, that's about 4% of the workforce. A lot of that is likely administrative bloat or maybe some redundant R&D projects that got spun up during the pandemic boom.
So they are just trimming the fat to boost the margins. It's an efficiency play.
And look at the guidance they gave. They are guiding for gross margins of 51% to 53% for 2026. That is absolutely elite for a manufacturing company of this scale. They're telling the market, we can do more with less. It's actually a very bullish signal for the stock, even if it's a tough break for those employees.
It's the mature growth phase. Okay, that makes sense. So we have the tech sector screaming at the top of its lungs, growth is back and it's accelerating. But then you look at the macro data. You look at gold.
And silver. Don't forget silver.
Right, silver is up nearly 60% year to date. That's insane. And gold is up 22% just in the last 4 weeks.
It's a staggering move, a truly staggering move.
So the question is, if the economy is so strong, if AI is booming and productivity is supposedly going up and ASML is selling machines hand over fist, why is everyone fleeing to the safety of gold? I mean, usually you buy gold when you think the world is ending.
Because of the D word, debasement.
Debasement.
We are seeing a fundamental shift in U.S. currency policy, or at least that's what the market believes we are seeing.
Yeah.
And it all hinges on comments coming right from the top.
You're referring to President Trump's comments from Iowa yesterday.
I am. He was asked by reporters specifically about the falling dollar. Now, keep in mind, for decades, the official U.S. stance, from Clinton to Bush to Obama, it didn't matter the party, was a strong dollar is in the national interest.
It was the standard playbook. It keeps imports cheap. It signals global strength. It helps keep inflation down.
It's just what you said. And Trump took that playbook and just threw it out the window. His quote was, I think it's great.
I think it's great. No ambiguity there.
None. He explicitly stated he wasn't concerned about the drop. The administration wants a weaker dollar to help exporters, to help manufacturing, to make American goods more competitive abroad. But when you combine a president who is comfortable with a falling currency, with really heavy fiscal spending, and all this geopolitical tension, the market hears one thing and one thing only.
Your dollars are going to be worth less tomorrow than they are today. Buy something real.
Exactly. So the debasement trade is essentially investors, big and small, saying, I don't want to hold paper money that the government itself wants to devalue. I want hard assets. Gold, silver, real estate, Bitcoin, anything that can't be printed.
It's interesting because there is an economic theory about this, the dollar smile, right? Stephen Jen's theory.
Right. Stephen Jen is a brilliant currency strategist, and the dollar smile theory is a really useful framework. It basically says the dollar does well in two scenarios.
The two ends of the smile.
Exactly. On one end, when the U.S. economy is absolutely roaring and rates are high because capital flows in. On the other end, when the rest of the world is crashing because the dollar is the ultimate safe haven, it smiles at both extremes.
But Jer put out a note recently saying the smile might be broken. Or at least it's not smiling the way it used to.
He thinks we're entering a next leg lower. And his big warning is that most analysts, most portfolio managers are not ready for a world where you have a strong U.S. economy driven by this AI productivity boom, but a weakening currency at the same time.
That is a weird combination. It feels counterintuitive. Usually a strong economy means a strong currency because people want to invest there. The capital flows in and pushes the currency up.
It's the classic correlation. But if the official government policy is explicitly to weaken the currency, to fund tariffs and boost exports, and if the fiscal deficit scares people away from buying U.S. treasuries, you can break that correlation. And that is why you see gold and these other hard assets catching such a strong bid.
So it's a flight from sovereign bonds entirely. It's not just the dollar against the euro or the yen. It's the market collectively rejecting government debt as a safe asset.
And we saw a massive sell-off in Japanese government bonds this week, too. It's a global phenomenon. Investors are looking at these enormous debt-to-GDP ratios everywhere and just saying, no thanks, I'll take my chances with something tangible.
And sitting right in the middle of this whole storm, trying to keep the ship upright is the Federal Reserve. And they are meeting right now as we speak.
They are. And the boring part of the meeting is the decision itself. The markets have priced in a 97% probability that they hold rates steady.
Right, 3.5 to 3.75%. The economic data is fine. It's not great, but it's not terrible.
Exactly. Unemployment is steady at 4.4%. They added 50,000 jobs, which is just kind of treading water. Core inflation, the PCE, is sticky at 2.8%. There's no fire, so they don't need to cut immediately.
The data says hold, but the drama, the real story, the Theta Fuse, is happening outside the meeting room.
It really is. This is what makes 2026 feel so different. The Fed is supposed to be this independent, quasi-academic institution. It's supposed to be above the political fray. But right now, it feels like they are under siege.
It feels like an institutional crisis is brewing. You have the Justice Department opening a criminal investigation into the chair, Jerome Powell.
Right, regarding his testimony about, of all things, headquarters renovations.
Which, look, regardless of the merit of the case, and it sounds like a paperwork issue more than anything, is an incredible amount of pressure to put on a sitting Fed chair right in the middle of a policy meeting.
It's an intimidation tactic. Let's just call it what it is. Whether the case has merit or not is almost irrelevant. The point is to freeze him, to make him feel the political heat.
And at the exact same time, the Supreme Court is hearing arguments on whether the president has the authority to remove Fed Governor Lisa Cook. So the very structure and independence of the Fed's board is being challenged in the highest court.
And meanwhile, we know Trump is actively shopping for Powell's replacement. The list seems to be narrowing. We keep hearing three names over and over again.
Kevin Warsh, Chris Waller, and the wild card, Rick Reeder from BlackRock.
Right. And it's worth handicapping this for a second because who is in that chair matters immensely to everyone's portfolio for the next 4 years.
Okay, let's start with Kevin Warsh. What's the book on him?
Warsh is, he's the establishment favorite in some circles. He's a former Fed governor, so he knows the plumbing of the system. He's relatively young. But he's historically been a bit of a hawk on inflation.
He worries about sound money.
He does. And that might not fit the weaker dollar agenda that the White House seems to want. You could be a point of friction there.
Okay, then you have Chris Waller.
Waller is the continuity candidate, in a way. He's already on the board of governors. He's considered the intellectual heavyweight behind a lot of the recent soft landing theory. Promoting him would be the smoothest transition. He's respected by the staff economists at the Fed, which is important.
But then there's Rader. The BlackRock guy, that feels like a whole different direction.
That is the disruption play. Putting a bond market practitioner, someone who actually manages trillions in assets for BlackRock, in charge of the Fed. That would be a seismic shift. It signals that the Fed would care more about market stability and liquidity than about traditional economic theory.
It would be like putting a race car driver in charge of the Department of Transportation, someone who knows how the machine actually works on the track.
That's a great way to put it. But here is the key point for the market today. What do all three of these candidates have in common relative to Jerome Powell?
Well, the market seems to think they are all more dovish. They're all expected to cut rates sooner and faster.
They are all viewed as likely to cut rates faster, yes.
Yeah.
The consensus is that any of them would be more inclined to get rates down to that neutral 3% level to keep the growth engine humming along.
So if you're a trader, you're looking at this whole picture and thinking, okay, they're going to hold rates today, but the political pressure is immense. The current share is literally being investigated, and all of the likely replacements are dovish.
Which just reinforces the debasement trade. It's a feedback loop. If the market thinks the next Fed chair is going to come in and slash rates to support the administration's weak dollar policy, then of course you buy gold. Of course you buy hard assets. The market is pricing in a complete regime change at the central bank.
It's amazing how these things all link up. You really can't look at ASML without looking at the dollar, and you can't look at the dollar without looking at the Fed's future.
It is all one big trade right now.
I want to zoom out a bit, though, because we call this a global deep dive for a reason. And there are two other countries flashing some major signals right now. It's Japan and Brazil. And they seem to be on completely opposite ends of the spectrum.
Two very different stories, you're right, but both are what I'd call coiled springs in their own unique way.
Let's start with Japan. I mean, for decades, the story in Japan was stagnation, deflation, the lost decades. But that seems to be well over.
It really does. The Bank of Japan just upgraded their growth forecasts. They are looking at 0.9% growth for fiscal 2026 and then 1.0% for 2027.
Which sounds small if you're used to emerging markets or even the U.S., but for Japan, that's a boom. That's a significant acceleration.
It's very solid, sustainable growth.
Yeah.
But the magic number for them is inflation. They've managed to get it to slow down to 2.1%.
That seems to be the sweet spot. Not too hot, not too cold.
It is. It's the Goldilocks number. They're actually calling it Senanomics after the Prime Minister, Sanai Takaichi.
Janomics. We do love a good anomics label in finance, don't we? So what is the actual policy behind the name?
It's a pretty clever mix of targeted energy subsidies, which help cool down the cost of living for consumers, combined with a lot of government pressure on corporations to raise wages.
So it's supply side and demand side.
It is. And the thesis is that Japan is finally, after 30 years, entering a virtuous cycle where wages rise, which leads to more consumption, which encourages companies to invest more, which then leads to higher wages.
So if you're an investor sitting in New York or London or Singapore, why do you care about Japan right now? What's the trade?
It's diversification. If you are worried about the U.S. dollar debasement we just talked about, but you still want exposure to a developed market with strong rule of law, Japan is looking very, very attractive. The ETFs that track domestic demand, so think banks, retailers, construction, they seem poised to benefit from this internal recovery. It's a nice non-correlated hedge against some of the volatility in the U.S.
Okay, so that's the steadier recovering patient. Then we have Brazil, which feels, wow, it feels a little more like a casino right now.
Brazil is the high-risk, high-reward play. It's the definition of a coiled spring. I mean, it had a knockout year in 2025. The stock market rallied 38%.
38% is huge.
It is. But here's the setup that makes it so interesting. They have incredibly high real interest rates. We're talking 15%.
15%? That is just suffocating for an economy.
It is completely suffocating the economy. It's a massive break. But the good news is inflation has been tamed. So that metaphor of a coiled spring is perfect here. You have an economy that is being held down by this massive weight of high interest rates. The moment the central bank starts to cut those rates, the economy could just explode upward.
Whoa.
Everyone is just waiting for that easing cycle to begin.
There's always a but. There has to be a catch.
There is always a but in emerging markets.
Okay.
And in Brazil, the but is the 2026 election.
Right. Lule's retiring.
He's 80. He's had some health issues. He's stepping down. And the vacuum he's leaving behind is creating a massive political showdown. You have the Bolsonaro family trying to make a comeback, specifically his son, Flavio.
And who is the market rooting for in this race? Because usually the market just wants stability above all else.
The market absolutely loves Tarcísio de Freitas. He's the current governor of São Paulo, the economic engine of the country. He's viewed as the technocrat, the engineer,
Yeah.
the guy who can actually fix Brazil's fiscal problems without causing social chaos.
And what happens if he wins?
The quote from the analysts at Global X is that markets will rally like there's no tomorrow because you get the rate cuts from the central bank, plus a pro-business, reform-minded president. It's the dream scenario.
And if he doesn't run, or if he loses?
Then you have a fiscal deficit problem that is just not getting fixed. Brazil needs to tighten its belt by about 2–3% of GDP. That's a huge number. If you get political chaos instead of reform, that 15% interest rate might not be enough to save the currency from collapsing.
So it's completely binary.
It is. That's why Global X is only marginally overweight. They're watching the polls like hawks. They like financials like Itaú Unibanco, but it's a nervous trade.
It's either a moonshot rally or a potential fiscal crisis. There's not much in between.
Exactly. And speaking of moonshots.
Ha, I see what you did there. We have to talk about the grand finale, the story that is lighting up every single group chat I am in, SpaceX.
It is the big one. It's the only thing anyone wants to talk about.
The Financial Times is reporting that Elon Musk is targeting a mid-June IPO. But it's not just the IPO itself, it's the valuation they're talking about.
$1.5 trillion.
1.5 trillion. Let's just put that in context for a minute. That is bigger than Meta. It's bigger than Amazon was just a few years ago. That is roughly the entire GDP of Spain or Australia.
And it would be by far the largest IPO in history. It would just blow the Saudi Aramco IPO out of the water. I mean, Aramco raised, what, $29 billion? SpaceX is looking to raise $50 billion in one shot.
But how do you even begin to justify that number? I mean, launching rockets is cool and landing them is even cooler, but is it a $1.5 trillion business?
See, the rockets are just the delivery trucks. The real business is the data. It's Starlink. The valuation is a Starlink valuation.
So you're not valuing it as a rocket company, you're valuing it as a global telecom monopoly.
That's the only way the math works. If you believe Starlink becomes the default internet service provider for the entire developing world, plus the aviation industry, plus the maritime shipping industry, plus the secure communications backbone for the U.S. military and NATO, suddenly the recurring cash flow models start to look like a global utility company, but with tech growth margins.
It's the ultimate toll road for data in space. You own the pipes.
That's the pitch. You own the sky.
But the thing that really caught my eye, and this is just peak Musk, it's so on brand, is the timing.
The planetary alignment.
He literally wants to time the IPO with the conjunction of Jupiter and Venus.
And his 55th birthday, which falls around the same time.
Of course. Because why wouldn't you?
You know, it's easy to laugh at the astrology aspect of it. It
Right.
sounds completely ridiculous. I'm basing my S1 filing on the position of Venus.
Yeah.
But I think it actually signals something really important for traders.
Oh, yeah. What's that?
It's a signal of supreme confidence. Musk has a history of this kind of symbolism. Remember taking Tesla private at $420? Or changing Twitter to X. He loves to blend meme culture with high finance. But to propose timing a $1.5 trillion listing based on the stars, it tells you that he knows the demand for these shares is absolutely insatiable.
He's basically saying, I am the market.
That's exactly. He is saying that he doesn't need to wait for a calm window in the VIX. He doesn't care if the Fed is hiking or cutting. He doesn't care if the dollars is up or down. He is creating his own gravity. The market will come to him.
It's the ultimate power move. And frankly, if the rumors are true that SoftBank is looking to dump another $30 billion into OpenAI in the same summer window, it suggests there is a terrifying amount of cash sitting on the sidelines just waiting for a place to go.
It's the liquidity trap. If you're a sovereign wealth fund and you don't buy SpaceX, where do you put your $1 trillion? In bonds. No, we just established that sovereign debt is scary. In cash, no, you're worried about debasement. You have to buy the innovators. You have to buy the hard assets that are changing the physical world.
So if this actually happens in June, it's basically the ultimate liquidity event. It's a vacuum cleaner sucking up all the available capital in the room.
It validates the entire space economy. It validates the Starlink revenue model. And it creates a new Mag 7 member overnight. It would instantly become one of the most important stocks in the world.
It is absolutely going to be a wild summer.
Absolutely, no question.
So, okay, let's try to pull all of this together. We've covered a lot of ground here. We have the tech supercycle, which seems to be confirmed by ASML's bookings and that move to high NA. We have the currency regime shift, confirmed by the president's comments and the price of gold. We have a Fed that's in political transition, and we have the biggest IPO in history looming on the horizon.
When you lay it all out like that, the picture becomes a lot clearer, doesn't it? That wait-and-see approach that the Fed is officially taking, it's a mirage. The water looks calm on the surface, but underneath the currents are just ripping.
The Theta Fuse is burning down.
It is. And you have two massive engines driving this market right now. Engine number one is the AI and tech trade. It's about productivity, growth, ASML, SpaceX. Engine number two is the debasement trade. That's gold, Bitcoin, real assets, the flight to safety.
And usually those two engines don't run at the same time. Usually you buy gold when growth is dead and you're scared.
That's the anomaly of 2026. That's the split-screen reality you started with. We are buying growth because technology is fundamentally revolutionizing the world, and at the same time we are buying gold because we don't trust the currency that the growth is denominated in.
That is a powerful and, frankly, a dangerous combination.
It is. It's an unstable equilibrium.
Before we sign off, I want to leave our listeners with a thought to chew on. You mentioned Stephen Jen's theory earlier, this idea of a weak dollar and a strong U.S. economy coexisting.
Right. The broken smile.
If that happens, if the dollar really does enter a long-term structural decline while the U.S. economy keeps booming thanks to AI productivity, what happens to the rest of the world? Specifically, what happens to emerging markets?
That is the trillion-dollar question, isn't it?
Do they boom because a weak dollar makes their dollar-denominated debt cheaper to service? That's the textbook answer. Or do they crash because all the capital in the world flows back into U.S. equities like SpaceX and NVIDIA, leaving them starved for investment?
It's that vacuum cleaner effect you mentioned. The U.S. might just suck up all the liquidity, even with a weaker currency, because it has the most innovative companies. It's a scenario that the old macroeconomics textbooks don't really have a chapter for.
Something to think about as you watch the tickers today. Keep an eye on ASML, keep an eye on gold, and for heaven's sake, keep an eye on Jupiter and Venus.
Literally, keep watching the stars.
That's it for this special edition of The Deep Dive. We'll be tracking the Fed's decision and the fallout all week. Thanks for listening.
Stay curious out there.